Hi, everyone, and welcome back to the Nick Halaris Show. Our guest this week is Danielle DiMartino Booth. She is the CEO and Chief Strategist at QI Research and one of the most widely followed and widely respected voices in the global Wall Street today. Danielle, welcome to the show.
It's great to be here. Thank you for having me.
Yeah, I've been really excited. I've been following your work for many years. I first came across your work on Real Vision. God, it feels like 8 or 9 years ago now. And watched you build your business, publish your book, and just honored to have you on the show and get it, pick your brain on some important topics. So thanks. I thought we'd start with, maybe just to get your take on whether or not the Fed is in the process of making yet another policy mistake. What's your take on that?
Well, the answer would be yes and no. If you're looking purely at what's happened with home sales in the first quarter of 2024 or car sales in the first 3 months of this year, then yeah, your answer is a resounding yes. Monetary policy should be easier if you're talking about it in the sole context of borrowing costs being lower for big ticket items. Of course, that's one of the things that the Fed controls. There are a lot of other bigger picture issues that are going on in the background. The Fed is in the process of pursuing sweeping regulations that would change the way the conventional banking system interacts with what we call the shadow banks. The shadow banks they're the private equity kingpins of the world. The non-banking sector, just to put it in broad terms, is $250 trillion worldwide, whereas the conventional banking system globally is 180 trillion. So it's a larger entity by far. And one of the only ways to rein in the control that private equity has had, the control that the non-banking sector has had in terms of making borrowing prohibitively more expensive for certain cohorts of society, and it really does get down to that, is to be able to push through with these regulations. And in order to do so, the Fed is going to have to stay higher for longer than it otherwise would. There's a bigger agenda right now that is at play than simply what the exact level of interest rates are and where they should be. So in the most plain vanilla sense, is the Fed committing a policy error? Yes. Layoffs are high enough, even if you're not seeing it in the formal data, in the official data. Layoffs are certainly high enough. There's certainly enough pain being felt throughout the economy for the Fed to be considering lowering interest rates at this juncture.
Yeah, that's fascinating. So I'm in real estate. And so I've sort of been feeling the pain for 2 years and noticing sort of conditions that you find in financial panic and distress. Like we've had even, some tragic events where developers and investors are committing suicide because they can't get themselves out of their kind of financial conundrum with banks. So like conditions are really, really bad in my world. And yet every day I turn on the TV and the stock market's going higher and higher, and the jobs numbers don't seem to be reflective of all the people I know who've gotten fired from their tech jobs. So it seems like we live in this sort of Goldilocks world, or the data is presenting a Goldilocks vision, but in my view, there's real pain in the economy. And it sounds like you're seeing that as well.
I am. I'm seeing a lot of the pain. I think probably what's really insulting, if you will, for so many is that the latent inflation, if you will, is still around. The gallon of milk that costs more than it did in 2019 is still more than expensive than it was in 2019. It'll probably never get back to that price ever. But in addition to this inflation hangover, if you will, now people are being told that the labor market is strong. It doesn't matter if they're losing their jobs. It's not what they're being told. They're being told that the labor market is really tight, that it's really strong. And They're seeing it reported in initial headline figures on a monthly basis or even on a weekly basis. We've had initial jobless claims in 160 million workforce U.S. economy come in at 212,000 in 5 of the last 6 weeks. It's statistically impossible against the backdrop of 160 million workers. But B, it almost makes those who've lost their jobs feel as if they're being alienated, or as if they're paranoid or imagining something, because it's not what the headlines are dictating. So I don't know if it's only because it's an election year, but I will say that I'll be happy when the data actually line up with what's happening on the ground again, because at least households who are losing their jobs won't be nearly as insulted as they're being now.
Yeah. Interesting. So you mentioned something in your first answer about the Fed's other agenda around the sweeping regulations and the shadow banking. Can you give me a flavor for what they're trying to do and what that means from a practical standpoint?
Well, if you've been involved in commercial real estate, you can probably attest to the fact that securitization over the years may or may not have made deals price at levels where they should not have, and that the vestiges of securitization are leaving today such big, huge equity holes to be filled in order for any given building project to be refinanced, that it's just too much. You can't come up with that kind of cash. What these regulations would do would make they would put more skin in the game, and they would require that lending go back a little bit to where it was in terms of being more realistically underwritten as it used to be in a bank before you had the sucker buying the mezzanine tranche. And I just probably said something that most people have no idea what I just said, but I think they're trying to make lending cleaner again.
Okay. And can they do this without acts of Congress? Like these are like wonky banking regulations that they can try to pass through, or do they need Congress to step in and to get this done?
Well, the Federal Reserve is a regulator, and these regulations would, of course, be done in conjunction with other regulatory agencies. This isn't that they have full control. Obviously, Congress is jumping up and down and spitting mad at the idea of raising capital requirements. I think that might be something of a red herring, that the Fed might be willing to be a little bit more flexible on raising capital in order to keep the regulations that start to impair the 3/4 of JP Morgan Chase's business model that is the capital markets. Obviously, the biggest banks cater to the non-banks, and that is where I think the real meat on the bones is when it comes to this regulation, and that would be in the Fed's purview.
Interesting. Yeah, like in my own personal experience, I'm just thinking I've been doing real estate investing for like 15, 16 years, and when we started, the banks were like unable to lend to us because it was like post GFC and they were afraid of all real estate deals. So we watched this shadow industry emerge, and we started using the shadow banks, the funds, the private debt funds and things like that, and securitization. And we came to rely on them because the banks were annoying. They felt like you were dealing with like the DMV when you go to a bank to get a commercial real estate loan, where your like personal net worth of the partners is 5x the loan amount, and they still put you through this brain damage. You can just go to one of these funds, these hedge funds, for lack of a better way of saying it, and they'll just close it. And so I've seen it, and they've taken up a huge share as a result, because people like me and my partners are like, why would we go deal with JP Morgan when we can go to this hedge fund who speaks our language? But it sounds like they have been playing in an unfair playing field with JP because they're not being regulated the same way. Is that basically the story?
They're not being regulated the same way, and you always have to say to yourself, if it looks too good to be true, maybe it is. So maybe some of these deals were done at unrealistic cap rates. I'm just trying to be very diplomatic here.
Yeah.
And now we're seeing what realistic cap rates should have been when the deals were originally penned, and now what it costs to refinance them. And again, the divide in between original levels and where we are now, for some people that entails so much cash, so much equity that there's no way to bridge the gap.
Yeah. And we've seen some high profile distress groups unable to recapitalize already. But I'm surprised we haven't seen more, because honestly, if you do the math on even like a pretty conservative asset, like a multifamily deal, if you do the math on it, nothing really makes sense without a huge equity paydown in the whole country. Like, I don't even understand. In my market, I live in West Hollywood and I invest a lot in this little market. And we're still seeing deals trading like the 4.5 cap range, which makes absolutely no sense when Fed funds is 550 or whatever it is. But I feel like
Remember that distress is in the eye of the beholder, and that a lot of money was raised very quickly. What I like to say about distress is that you should be the second one in as opposed to the first.
yeah, right. Then you know for sure it's a problem. And
Well, I'm
it's
just saying that the initial distressed transactions are going to occur at levels that are not really distressed.
right. Okay. Makes sense. And so why does the Fed need the rates to be higher to execute this regulatory overhaul?
So I think what the Fed is doing right now is it also has to do with shrinking the size of the Fed's balance sheet. The Fed can no longer be this massive player, certainly with the footprint that it's established in the Treasury market and also the mortgage-backed securities market on the residential side. So it's definitely time to slowly, and it will take time with prepays as low as they are on residential mortgages, but it is definitely time for the Fed to extricate itself from this business of what we call credit easing in monetary policy wonky circles. And credit easing is actually against the original 1913 Federal Reserve Act. So you need higher for longer rates for the Fed to justify not being at DEFCON 1 and taking rates down aggressively, but at the same time trying to shrink their balance sheet, which is another form of tightening.
I see. And they're trying to like get rid of as much excess as possible before they cut rates again, so that they're at least at some more of a level playing ground the next time they need to cut rates, and maybe do QE like 20, whatever version of QE we're going to be on the next time.
Yeah, I think
Okay.
they actually might be avoiding QE the next time.
Okay.
So
Interesting.
they're certainly going to avoid mortgage-backed securities QE the next time. If I mean, you never know what the future holds, but if I had to guess, I think that they're out of that business, and I think that they're probably hoping to avoid future forays into QE because it's proved to be something of a failed policy.
Yeah. I want to ask about that. But before I do that, I want to ask this question, because you're someone who has a lot of actual personal experience in the Fed. You've spent quite some time there before you broke off and started your research and writing work. And the question is, how is it possible for the Fed to make the kind of mistakes that we've seen it make? So, like, for example, like where I go with this is like transitory inflation. All you had to do was talk to anybody who's in real business, and you knew that transitory inflation was a fake phrase. But how does that get by the Fed and all the way to the chairman saying it on national television, in your opinion?
So it's a really long story. A lot of it has to do with political infighting at the Fed. At the time, there was a leadership crisis. It's very difficult to describe succinctly, but Jay Powell was being pitted against Lael Brainerd at the time, who was inside the Fed in terms of who was going to be the next chair of the Fed, whether Powell was going to be renominated or whether Brainerd was going to be nominated. And when you have an institution that is can be philosophically divided, as was the case with the Fed, if there is a leadership crisis, then you end up with policy paralysis, which is exactly what the Fed had. And the day, of course, that Jay Powell got reconfirmed by the Senate, the word transitory was thrown out the window. And that was about as symbolic as a move as I've ever seen in all of my years of being inside and outside the Federal Reserve. The other irony, though, is that if you look at inflation, if you look at a chart of inflation right now, it doesn't look like a thin V, but it definitely looks like a fat V, where it went up and it came down. So to me, at least, one of the Fed's fatal flaws has been communication. Maybe the word transitory was wrong, but the fact that when the government turned the spending spigot off, inflation came tumbling back down, that's indicative of the fact that they were probably had their heads in the right places. Now, did they know that $800 billion in Paycheck Protection Plan money, or more than $500 billion in employee retention credit, did the Fed anticipate this extra cash injection going in to the U.S. economy and prolonging inflation well beyond anything that was, I think the employee retention credit was budgeted around 50 billion. And I think 550 more than that billions been dispersed for this program. I don't think that anybody could have fathomed the fraud that was committed in the name of extending COVID fiscal programs that in turn prolonged the inflationary impulse of what Ben Bernanke years ago called helicopter money. Because that's all it was. That's all this entire exercise has been. Call inflation what you want, but money was directly deposited into U.S. household bank accounts. A lot of wealthy people were the biggest recipients of these paycheck protection loans and the employee retention credit. There's those two famous pictures, one of a Lamborghini, one of a G-Wagon, and their license plates say PPP loan. So we know it happened. It was flagrant. They flaunted it, but it created inflation. And then when the money stopped, the inflation's come back down to earth. It's kind of mechanical. So you can get angry at the Fed about transitory and using the wrong word as a descriptive, but what they were witnessing was not supply chain driven. It was demand driven because you gave people cash and they spent it.
Right. And so in that case, putting aside this sort of part about the infighting, political infighting, they were sort of right about transitory, but they just didn't communicate it correctly. Like transitory meant not like next month, but get rid of the fiscal stimulus impulse and inflation probably goes away. And that's what they could have said. Yeah.
Yes, they could have said that, but they're supposed to be independent. They're not supposed to have a say in fiscal policy.
Yeah.
They're not supposed to. And at a certain point, when they had stopped monetizing the fiscal debt, but again, in the beginning, they bought up most of the debt that was being issued by the federal government. So they were, again, going against their mandate. They were monetizing the debt. That's a big no-no.
Yeah. On the QE front, I believe you were in the Dallas Fed in an era when the Fed was pursuing QE, at least for part of it, right? And my question is, were there conversations that you witnessed or you took part of where members of the Fed were talking about the potential negative impacts of that policy from like the wealth inequality standpoint and discussing like, hey, maybe this is impacting American society in a negative way for these reasons, or is that just not something that people at the Fed think about or talk about?
So the consequences of monetary policy were frighteningly untouched when I was on the inside. There were practical discussions that occurred that we're actually seeing play out today in a different way. We discussed the fact that if the Fed was to engage in quantitative easing for mortgage-backed securities, that future impaired immobility, the inability for households to move because they're prisoners of a 2.75% mortgage rate, that could seriously impair mobility and hamper the ability to move to get a new job, which is part of what we do as young Americans. Young Americans move to get jobs. So in that sense, there was thoughtful discussion that was had. I was part of that thoughtful discussion. I was on the losing end. But in terms of that level of self-introspection, nope, there wasn't. It's why I wrote Fed Up, an insider's take on why the Federal Reserve is bad for America. That was my subtitle. But that level of introspection did not exist. And that is, to this day, to me at least, intellectually criminal.
Yeah. It seems like there's such a clamoring, at least from people who've like studied this, about the negative impacts, and yet the press doesn't really cover it in any detail that would be useful to the American people.
No, you have to understand it to cover it.
Right. And so that's the issue. Like there's a few specialty places where you can go if you're like smart enough to figure it out, but most people don't really even understand. And I know there was one article written by Bernanke. I forget what newspaper he put it. I think it was like it's one of the Washington, D.C. papers where he basically admitted to what they were going to do. He's like, hey, we're going to do this wealth effect thing, and hopefully that stimulates the economy. But then I don't know if the American public really understood even that, even though it was pretty clear in that op-ed. But what do you think about the op-ed?
Well, the way he was referring to the wealth effect is the, unicorns and rainbows, happy ending, trickle down theory. And that's failed. So,
yeah.
I don't have too terribly much respect for his body of work.
Yeah. Well, I know you've got to get going to something very soon, and I want to spend the rest of this conversation just getting your take. Like, it's kind of an open-ended question, but you've got this experience working at the Fed. You've written about it for years. You've written a book about it. You talk about it regularly. My question is, what should we, as Americans who are concerned about this, like, what should we be thinking about doing differently? Like, if you were in charge of reforming the Fed or reforming the system, what would be the policy intervention or policy changes that you would pursue? And it might not be one answer. There might be a bunch of them, but just curious kind of where your head is at on how we fix all this.
So I think how we fix all of this comes down to financial literacy and accepting first as adults that living beyond our means it paves the road to unhappiness. And if that's what we teach our children, then we perpetuate a cycle. If the American culture can detach itself from having to access credit just to feel good, and again, living so far beyond their means by accessing credit, which requires financial literacy. It's simply a matter of financial literacy. Then you break the symbiotic relationship. You break the stranglehold that the Federal Reserve has on American society. Because in the past, Federal Reserve officials have been very forthright, and they sound extremely intelligent and articulate when they talk about things like Bill Dudley did during the heat. He was the head of the New York Fed during the heat of the financial crisis. Just take home equity out of your home, and that'll spur consumption. That'll help the economy. Yeah, well, okay, but it's not going to help your long-term financial well-being at all. So I think if we have a deeper appreciation for how finance works through our individual lives, our individual budgets, and our eventual hopeful financial independence, then we will understand that debt is not it's not the panacea that we think it is, and it's not the panacea that Fed policymakers often dictate and tell us that it is.
And the Fed basically has encouraged debt by making debt inexpensive, unnecessarily inexpensive for too long. Is that the idea?
They have, but not in the most direct way, right? They make debt very inexpensive for the larger lenders. And then the lenders in turn to individuals, they always get their pound of flesh. The working man and the working woman, they never ever see zero interest rate policy in their lives.
Right.
There's always a margin of profit in between the people who are on the receiving end of zero interest rate policy and the people who cut a paycheck twice a month and are on the they never get zero interest rate policy. And that, again, there's something very broken in the transmission mechanism of monetary policy if the only ones you're benefiting are the lenders who are going to make profit on the backs of the individuals doing the borrowing, further widening the inequality gap in the process.
Yeah, it's like I had Wolf Richter, who has a really cool blog that he's been publishing, and he's been really negative about the Fed on this wealth inequality point. And he was talking about how in the aftermath of the GFC, like he went through the way in which those policies benefited people like in the shadow banking system or in the banking system, how they got like these phenomenal opportunities provided essentially by the Fed. And it did kind of trickle down, like in a sense, it trickled down because some people were able to get low price loans, but they weren't benefiting like these sophisticated financial institutions who were borrowing for basically nothing and then lending for a higher number and making the spread.
Wolf's got a good point.
Yeah. What do you think the Fed has like a governance problem from an independent standpoint? I know it's supposed to be independent, but do you, based on your own experience and study of the Fed, is the Fed independent? Is that something Americans should be focused on? The nexus between the politicians and the Fed governors?
Well, I certainly think that Powell is one of the most independent Fed chairs that we've seen in generations, probably since Paul Volcker was in office. That does not take away from the blatant partisanship that's been attached to confirming some of the most recent governors who've been confirmed onto the Federal Reserve Board. I think that Fed independence is something that needs to be addressed and addressed aggressively, because when you look at Greenspan and then Bernanke and then Yellen, they were increasingly politicized chairs at the Federal Reserve. And again, there are very few people left on the Federal Reserve after a handful I can name, including Powell, Christopher Waller, who will be left when Powell leaves in a very short period of time. It's almost May of 2024. That means that, the 2-year tickers, it's going off in the background. I doubt he stays for a third term. I doubt anybody will want for him to stay for a third term if he manages to keep monetary policy as tight as he has, which he remarkably has, the longest since Paul Volcker was in office, his current stretch. So I doubt any president's going to want to keep him in office. They want somebody who's going to bend to the will of politicians to keep interest rates at artificially repressed levels. And then we're right back to where we started, with a very politicized Fed. And that certainly needs to be addressed.
That's something like we should focus on. Yeah, I saw something or heard something where I think it was during the Obama administration that Yellen had like a weekly meeting on Obama's calendar or something like that, which it seems like it would be hard to be independent if you're meeting with the commander in chief and the president of the United States every single week. It sounds like Powell.
And don't get me wrong, Powell has had more. He's had more meetings on the Hill with individual members of Congress than any of his predecessors from both parties. So, because again, the Federal Reserve does answer to Congress. They certainly do not answer to any administration, or at least they're not supposed to.
Yeah. Fascinating. Well, let me just ask one final question and then I'll let you get on with your day. If you were sort of in Powell's seat, what would you be doing right now?
Sadly, I'd be doing the same thing he's doing. I would be hiding behind specious data in order to try and press forward with with trying to regulate the shadow banking system and at least leave that as my legacy. That's all he really can do. When you walk into a situation that he described in October of 2012, when he was a rookie on the Federal Reserve Board, that if we get too far into this business of growing the Fed's balance sheet, when the time comes to exit, it's going to be very, very difficult indeed. And that's what he said 12 years ago. And that's what he has confronted in his role as Fed chair. And he knows that right now it's just making a choice between what's worse and worst. And when you have to make a choice between two bads, sometimes it's difficult.
Yeah. But it seems like the going after what he's going after is, it might be in the long-term best interest of the country, even though, yeah, maybe
in the long-term
yeah,
best interest of the global financial system and
yeah,
society at large and world peace.
yeah.
Yes.
Even though it might cause a recession, it might cause a bunch of real estate deals to blow up. Like, we're talking about something that's systemically way more important here, which is interesting.
Yes. I mean, and that's what most people on Twitter are like, he's going to bend like fold like a deck of cards. And I'm like, he hadn't yet.
Yeah.
And if he really is trying to win one, for the little guys, then let him.
Yeah. Well, fascinating. Appreciate your perspective and time. I will make sure everyone knows where to find you and links and whatnot as when we release the podcast, but appreciate you being with us, Danielle. Thank you.
Thank you for your time. Thank you for your questions.
Yeah. All right.